Are you worried about choosing the wrong business entity structure? Or are you lost or confused on how everything works and what's the difference between them? Choosing the wrong business structure can cost you more than just money. It could potentially cost the business itself. Hi, I'm Kevin Andrade. I'm a CPA licensed in the state of Maryland, but I work with clients nationwide. With over 10 years of experience, I help small business owners and high W-2 income earners legally and proactively save on taxes. I've seen my fair share of businesses get in hot water or are just inefficient for tax purposes, which can cost you thousands of dollars in taxes paid. The good news is that you don't have to make the same mistake. In this video, I'm gonna break down the 5 most common entity structures, go over the pros and cons, and provide suggestions on when you should consider what entity structure for you. We're gonna cover liability protection, taxes, and when to consider each entity. And with that said, let's jump in. So we're gonna start off by talking about sole proprietorships. Sole proprietorship is the most simplest and most common way to start a business. It's just you. There's no separate entity, there's no legal structure, and there's no state filings that are required. Let's go over the pros of a sole proprietorship. Number 1, no setup costs or paperwork. You don't need to file with the state to start. You simply just can go out in the world, earn self-employed income, earn that first dollar, and boom, you're a sole proprietor, which unlocks then tax deduction. And if you want to operate as a name, as like a business name, you can do something called a DBA, which stands for doing business as. It's not a formal entity structure. Rather, it's a trade name that you can use for business purposes and for marketing purposes. In order to use a trade name, you must register with your state. For freelancers, gig workers, or startups, this simplicity is a major advantage. Number 2 is easy tax filing. You report all of your business income and expenses on your personal tax return on a form called Schedule C. So there's no separate business tax filings that's required, no corporate rates, none of that. The third pro about being a sole proprietorship is that you have full control. You are the sole owner. You make all of the owner decisions. There's no need to consult with partners, investors, shareholders, or other board members. Now let's go into the cons of a sole proprietorship. Number 1, unlimited personal liability. You are operating as yourself. Your personal assets are at risk. This includes your home, your bank accounts, your savings, potentially your retirement accounts, are all at risk if your business faces legal action. Number 2 is no business credit. Since the business and the owner are the same entity structure, your personal credit score affects your business. And number 3, it could be limited growth potential. Without legal protection or a formal entity structure in place, it could be harder to attract partners to come to work with you. And even some clients like to see a formal entity or see that LLC or Inc. at the end of the business name for some credibility. So what are my suggestions on when to choose a sole proprietorship? If you're testing a business idea, doing something on the side, like a side hustle, or if you're operating in a low risk industry, like freelance writing or photography, then that could be a good starting point on to just be a sole proprietor. Let's go over an example. Sarah's freelance writing business. So Sarah is a freelance writer who creates blogs for other small business owners. She didn't need to register a formal business structure. She simply opened her doors to new business, started accepting clients, and invoicing them. She reports her income and expenses on her personal tax return as a Schedule C. However, since she's a sole proprietor, if a client ever decides to sue her, for example, a missed deadline or something, her personal assets are at risk. That's why many people, as they grow and their self-employed income starts to creep up and get more profitable, they eventually transition into a more formal entity structure for asset protection. Let me close out the sole proprietorship entity structure with a pro tip. Set up a separate business bank account. This will help keep your finances organized and helps you track deductible expenses come tax season. Entity structure number 2, LLC. LLC standing for Limited Liability Company. An LLC is a step up from a sole proprietorship in the terms of asset protection. It separates your personal and your business assets while keeping your taxes straightforward. Let's go over some pros about being an LLC. Number 1, liability protection. If your business is sued for whatever reason, your personal assets are protected. For example, if you're a wedding planner and someone sues you over a cancellation, only the business assets are at risk. Number 2 is flexible taxation. By default, an LLC is taxed as a disregarded entity, meaning it would go on your personal tax return. However, there is flexibility for in the future when it makes sense that your LLC can elect to be taxed as a corporation, whether that be an S-Corporation or a C-Corporation, which could be extremely beneficial down the line for tax purposes. Number 3 is professional credibility. Clients and vendors often perceive LLCs as more legitimate than sole proprietorship, which could potentially help you attract more opportunities. Now, let's go over some cons about an LLC. Number 1 is higher costs. Most states charge a state filing fee when you create your LLC, and some states have a renewal fee of that LLC. For example, in Maryland, it costs $300 to open open an LLC, and then every year there's an annual registration fee or renewal fee of $300 they have to pay every single year. And this depends state by state. Con number 2 is compliance requirements. You'll need to maintain a registered agent, submit annual reports, and you have to stay on top of these compliance requirements. If you do not do so, you could potentially get your LLC revoked, which there goes your asset protection. Now, when does it make sense to be a single member LLC? If your business faces potential risks like client disputes or employee issues, an LLC is a great option. An LLC is perfect for insurance businesses, consulting firms, or real estate investors. Let's go through an example. Mike started a web design agency, working with clients to build websites and do some freelancing work. Since he interacts with multiple clients, multiple businesses, and have contracts involved, he set up an LLC for liability protection. Now, if a client sues for a dispute, only the business is responsible, not his personal assets. And the LLC has more flexibility down the line to elect to be taxed potentially as another type of corporation, which could benefit you for tax purposes. Here's a pro tip. Even though an LLC does create liability protection, you have to make sure you meet the compliance requirements of an LLC to maintain that asset protection. An example is commingling funds. You don't want to mix your personal and your business funds. You want to keep those two separate. In the event of a litigation, if they see you're mixing your personal and your business cash, that's something called piercing the corporate veil, which means you will lose your asset protection over your LLC. It'll be useless, and then you'll be sued for your business and your personal assets. Number 3, partnerships and multi-member LLCs. A partnership is a business owner with 2 or more owners. It could be a combination of general partners, limited partners, ideally those that share profits, responsibilities, and liabilities. A multi-member LLC or partnership is similar to a single member LLC when it comes to asset protection. Let's go through the pros first. Pro number 1, shared responsibilities. There's a reason why you go into partnership with someone besides yourself, and that's to bring together multiple skill sets to create a business, make it easier to manage and grow the business. For example, one partner might handle sales and the other manages operations. Pro number 2 is pass-through taxation. So partnerships or multi-member LLCs don't pay taxes at the entity level. Rather, that gets passed through something called a K-1, and then they claim the income, or the profits I should say, on their personal tax return. Pro number 3 is, as I mentioned, liability protection. Similar to a single member LLC, setting up a multi-member LLC for a partnership is fantastic when it comes to asset protection, as the business will be separate from the personal assets. Now let's go over some cons about a partnership. Number 1 is personal liability, specifically for general partnerships. You see, in a general partnership, owners are personally responsible for the business debts and potentially any legal issues. Let's use an example. We have partner A and partner B that are both in a multi-member LLC. Partner A is at work in the office, making money, growing the business. Partner B is on his way to work and gets into a car accident. Let's say it's partner B's fault, and then the other person sues partner B. Well, then partner A, if they're in a general partnership, will be pulled into the court case as well, even though he wasn't even there. He was at the office growing the business. Con number 2 is potential for disputes. You see, when multiple people are involved, there's going to be disagreements. That's why it's important to have a clear partnership agreement in place that outlines the roles, responsibilities, profit sharing, and what should happen if there is a disagreement. And con number 3 is self-employment taxes. As a partnership, you have to now file your own partnership tax return called a Form 1065. So that'll also increase your tax prep fees. In addition, since there's no taxes paid on the profits of your partnership, it gets flowed through K-1 to your personal tax return, which those profits are subject to self-employment tax, which is 15.3%. Now, at our firm, we have a strategy for partnerships to minimize the self-employment tax. And if you're interested in tax planning before creating a partnership, click the link in the description to apply to be a client. Now, when should you consider being a partnership? If you're starting a business with 1 or more partners and you're looking to bring in different skill sets to rapidly grow the business, then a multi-member LLC can be a great fit. Now, let's use an example of a coffee shop that was opened by Emily and Jake. They pulled their money and skills in to open the business. Emily is creative at creating different blends of coffee, while Jake could be great at sales and marketing. And since they're working together, a general partnership may have seemed the best way to start. However, they realize as a business grows, a multi-member LLC may be a better choice for asset protection. Here's a pro tip. If you're in a partnership, make sure you have clear roles, responsibilities, and exit strategies to prevent future disputes. Entity structure number 4, the S-Corporation. Now, an S-Corporation isn't a legal entity, it's a tax designation. You see, an LLC or a C-Corporation can elect to be taxed as an S-Corporation for tax purposes. And by electing to be taxed as an S-Corp, it can reduce your self-employment taxes, which for some business owners could be in the thousands of dollars. Let's go over the pros about an S-Corp. Unlike Unlike a C corporation, where profits are taxed both at the entity level and at the shareholder level, S corporations are pass-through entities, similar to partnership, meaning a K-1 will be distributed to the shareholder of the S-Corp. Another pro for an S-Corp is tax strategies. You see, what happens with an S-Corp, it actually unlocks other tax strategies that can help even reduce your taxes even further. The S-Corp alone will save you thousands of dollars of self-employment tax, but when you tack on all these different tax strategies, you can see those savings grow and grow and grow. Now let's go over the cons of the S-Corp. One of the cons is that there's strict compliance rules. For example, you can't have more than 100 shareholders, you must be a US citizen or resident, you must have payroll set up, you must pay yourself a reasonable compensation, and if you're not on top of all these compliance requirements, the IRS can look into this further and revoke your S-Corp status. Another con could be more admin costs. Similar to a partnership where a 1065 or a separate business return is required, an S-Corp also needs to file a separate business return called 1120S. We suggest looking into being an S-Corp once your business crosses over the $60,000 mark of profits, not revenue, profits. Let's use an example. Lisa runs a marketing agency and has $120,000 in net profits. You see, as a sole proprietor or a single member LLC, her $120,000 of profit would be 100% subject to self-employment tax, which we know at this point is 15.3%. 15.3% of 120K, you're looking at more than $15,000 of taxes that are owed in just self-employment tax. So instead, she elected to be taxed as an S-Corp. She calculated her reasonable compensation as half of the $120,000 of profit, so $60,000 of W-2 wages, and then the remainder $60,000 is considered an owner's draw or distribution. So the W-2 wages are still subject to self-employment tax, but the owner's draw is not. Here's a pro tip. Work with a tax professional to make sure you are meeting the reasonable compensation standards. By paying yourself too little, the IRS can come in, audit you, penalize you, and potentially revoke your S-Corp. So now we're at the final stage of the entity structures. Number 5 is a C corporation. A C corporation is a separate legal entity. It's ideal for larger businesses who want to scale, get investors, or potentially exit in 5 to 10 years. The pro of a C corporation is that you can issue multiple classes of stock and attract investors from all over. This is what makes C corporations essential for venture capital or IPOs. Another pro could be tax deductible benefits. You see, in the other entity structures, specifically partnerships and S-Corps, you are unable to write off fringe benefits. Fringe benefits could include health insurance, life insurance, disability insurance. Within a C corporation, you are eligible to take those deductions. Now, what are the cons about a C corporation? Well, number 1, you have double taxation, meaning you are taxed at the entity level at the corporate tax rate, which at the filming of this video is 21%. And then you're also taxed when the money gets distributed to you personally. Another con could be complex compliance. So you still have the business tax return that you have to do, but you also need to make sure you're following strict regulations, such as regular filings and making sure your books are in order 100%. So when should you consider being a C corporation? If you're building a high growth startup, looking to attract venture capital, you want to offer employee stock options, a C Corp is a fantastic choice. Let's do a quick recap on when you should consider upgrading your structure. Let's talk about sole proprietor to LLC. When your business generates consistent revenue and takes on more risk, you definitely want to consider upgrading your sole proprietorship to an LLC. Well, how about LLC to an S corporation? When your net income exceeds $60,000, you should consider being an S corp to start saving on self-employment tax. And lastly, when to consider upgrading from an LLC to a C corporation. When you desire external funding from venture capital, bringing in shareholders, and look to exit within the next 5 to 10 years, a C corporation could be best beneficial for you. Choosing the right structure isn't just a legal decision, it's a business strategy. If you found this video helpful, like this video and subscribe for more tax tips. If you're a W-2 earner or business owner making more than $250,000 per year and are interested in becoming a client, click the link in the description below to apply to be a client today. Until the next video, take care.